I want to talk about what a stock market index is, or an index as is often referred to. So I'm talking about, for example, the S&P 500 or the Dow Jones Industrial Average. Now, what do these numbers actually represent? Because they're often on TV and they're focused on the newspapers, up 1%, up 50 points, up 100 points. Well, basically, instead of looking at the price of one company by its share price, and looking at the market value of one company's equity through its share price, so for example, the market value of a company has gone up by 5%, its share price has gone up by 5%, we can look at the performance of an overall stock market or a portion of the stock market. And the way this is done is via an index. And so for example, the S&P 500 captures the market value of the equity of the 500 most widely held companies in the US. And the way this is done is by one of two methods for indices in general. An index is typically calculated either on the basis of market capitalization or on the basis of price. And what that means is, in the first instance, for a market capitalization index, which is the more common one, is basically all the market values of the equities of all of the companies in that index are added up. So let's say in the case of the S&P 500, the market value of the equities of all of those 500 companies are added up, and then to get it down to a manageable number, it's divided by a constant number, and at every point in time, using computers, all those market values of the equity as they change, of the companies in that index, as they change, are then again divided by that constant number to get it down to a manageable number, because these market values of equity would be in the billions, clearly. To get it down to a manageable number, it's divided by a constant, and that then is monitored, so we can see how, in aggregate, the market value of these companies in this index is going up or down on that particular day or that particular instant in time. Now, the S&P 500 was started at a base level of 10 in the period 1941-1943. So what we're seeing when we see the market, that index, go up or down, is we're seeing how those 500 companies, as per the definition of that index, how the market value of their equity is changing. Now, the second way that indices are calculated is based on price. This is used less commonly, and you could argue that because the share price doesn't really tell you that much about the value of the company, because it's really the share price multiplied by the number of shares that gives you the market value of the equity of that company, you could say that using the price is a somewhat different measure, because the price can be a little bit arbitrary in that, a company could have a share price of $50, but then they could decide to double the number of shares they have in existence, so all of a sudden the share price is $25, but the company actually has not become any more or less valuable, because it's really the value of the overall equity that defines the value of that company. So, but in the case of a price-weighted index, such as the case in the Dow Jones Industrial Average, the prices of all of the stocks, in this case 30, are added up and then divided again by a constant to get it down to an easy to follow number, and then we're basically monitoring the price movements in aggregate of the companies in that index. So those are what stock market indices are. They're ways of following groups of stocks using a certain methodology, either market capitalization or price, instead of following individual stocks at points in time.